You checked out the YouTube links?
The videos,
Yeah, okay. So I'm trying to do more of that. Is it clear, the vocal part? Clear enough? Okay, good. Okay, so exercise 3A-32. And I'll read off what they're asking us to do. At the beginning of the year, Nifty Advertising owed customers $2,500 for unearned revenue collected in advance. So what I might do, you know how I like my Excel thing, yeah? I might, and you could easily scribble this on a piece of paper. I might go ahead and, whoops, make myself what we call a T account. I think the T account describes it best. It lays things out best for you. So I'm going to have this T account for my unearned revenue account. And unearned revenue, what kind of account is unearned revenue? Anybody? Yeah, but what type of account is it? Revenue? Is it an expense? Is it an asset? It's actually a liability. Okay. Unearned revenue is a liability. I'll put liability in here so you know. So it has a normal credit balance. So if they tell me at the beginning of the year, we owed $2,500. So that means that this company, Nifty Revenue, had collected $2,500 from customers, but they haven't provided the advertising service yet. So that's why that's called unearned revenue. It hasn't been earned, right? Remember, the earnings process is when you actually do it or you deliver the goods or services, right? So in this case, they got the money up front, but they didn't perform the advertising services yet. So it's really a liability. Nifty owes their customer $2,500 worth of services. Okay, there's a liability. Okay. During the year, Nifty received advance cash payments of 86. So during the year they received 8,600 more. Okay.
More
advances on revenue, right? So they receive 8,600 more for work they haven't performed yet. Okay. Let's see what else it says. Okay, and on the side of this, they earn 50,000 in service revenue. So you could have another account, another T account if you wanted, and you could call it, this one we're going to call service revenue. Okay. So they actually got 50,000 in revenue that they earned. They actually earned this 50,000 during the year. Okay. And in parentheses it says exclusive of any amount earned from advance payments. So that means this 50,000 was straight earned. It's not any money that ended up being earned from what they got in advance. Okay. They just got that straight. Okay. So let's see. At the end of the year, the liability for unearned revenue is 3,800. So I would draw a line here, and I would say my ending balance is 3,800. This is my ending balance. Okay. In fact, you could put a double underline under that, just so you know. Okay. And unadjusted service revenue is 50,000. Okay. So what does this tell me? Whenever you analyze an account, right? Take this for instance here, what we're looking at in yellow. Okay. 2,500 was the beginning. The account increased by 8,600, right? So that's what, 11,100. That doesn't check out.
So you add advance cash to unearned revenue.
Well, the beginning's 25 and I added the 86, so that's 11,100, right? But they're telling me my ending balance is 3,800. So something had to have happened, right?
How come you're adding
You
that?
subtract the ending and you mark that as, what's it called, right?
Why are you adding them?
Why am I adding them? Because I'm analyzing the account, right? I want to see if this equals the ending, and it doesn't, right? I'm taking the beginning plus the additional amount that was added, And that's not adding up to what the ending is. It's more than what the ending is. So there must have been a debit, right? There must have been something on the debit side of this account that made it, reduced it down to 3,800, right? So what could have happened to make that a debit? Remember, this is a liability, so as we actually do the work, that liability is going to go away. So what would happen is, right, you would have debited unearned revenue, and what will we have credited?
Service revenue.
Yes, right? So you would have service revenue for the difference, for the amount that makes this account true, the amount that makes 2,500 plus 8,600 minus whatever that is, come down to 3,800. And somebody over here gave me the math, right? Basically add these two and subtract the ending. So you could go 2,500 plus 8,600 minus the ending, okay? And then you want to double check it, right? You want to come over here and say, okay, 2,500 plus 8,600 minus 7,300, does that equal 3,800? We'll just double check it, do a test, right? So the beginning plus the additional advances minus the amount that was earned because we ended up providing $7,300 worth of the services, it does, it balances. Okay, so we've made this account true. We've made it correct. Before we determined that we had 7,300 in revenue, the account wasn't correct because the beginning plus the additional advances didn't equal the ending balance. Yes?
Where did you get 7,300?
I derived it. Oh, so
you just did the calculation.
I did the calculation to make that account balance, to make it true, right? If I didn't have the 7,300 here, like I was saying earlier, 25 plus 86 is, what was it, 11,100, right? That's not 3,800, right? And the ending needs to be 3,800, so we need an amount here to bring it down to 3,800, right?
Can
Then-
you explain what advance cash
Okay.
is again?
So you started off this accounting period and you had 2,500 in there where you haven't provided the services yet,
Yeah.
right?
Okay.
Your customer gave you 2,500 in advance. Now, the year starts and your customer gives you another 8,600 in advance, okay? And you still haven't performed that work, okay? That, you were given the money up front to do the work.
Advance cash is kind of like another way of saying unearned revenue.
Well, before we even get to that, right, this is what the entry would look like. To get that 8,600 in there, it would have been a debit to cash and a credit to unearned revenue of 8,600. See how that works? So in your accounting system, you're receiving 8,600 in cash. You cannot call it revenue because you didn't do the work. So we call it a liability. We call it an obligation. A liability is an obligation.
Yeah, because you still have to do the work, so you're obligated to do the work.
Right.
And then once the work's done, you would just,
You do this.
yeah.
So 7,300 worth of the work ended up being done. You would have, let me slide this up so it's not down so low, right? When this happens, when you actually do the work, we move it out of unearned revenue. Notice we're debiting unearned revenue, so that's reducing the liability, and we're turning it into revenue, right? Remember, we cannot recognize revenue until we actually earn it, right? And the earnings process happens when we either provide the services or the goods, right?
So they're saying at the end of the year, 3,800 services was not done yet.
Yeah, it's not done yet. So they told you what the ending balance was. They told you what the beginning was. They told you how much you were advanced. But it's up to you to figure out, because you know how these accounts work, how much was actually earned as revenue. So it's up to you to back into it, basically. You have to back into that number. Now let's see if it works in our, what's the first thing they're asking me? Begin by recording the adjusting entry, assuming that Nifty records unearned revenue by initially crediting the liability account. So we are adjusting. This is the adjustment, right?
He's finding the debit.
Yeah. If I understand what they're asking me for. I think when we did this problem in the past, they asked for this piece first. but let's see. Unearned revenue and service revenue. I'm sorry, I think they want us to record the cash first. Okay, so that would be the 86. That's what it sounds like they're asking. Cash collected for future services. Wait.
Doesn't it say post the adjusted entry to unearned revenue and service revenue T accounts in the requirement 1?
Yeah, here it is.
So it would be the only two that you would work on with.
Yeah, you're right. So we would do this, right? And that would be the 73. That's to record the service revenue that was collected in advance, because we actually ended up earning it, right? There you go. You guys follow that? Make sense? Okay. Now I think we did this before we did this, right? So I think these T accounts are basically what I did here. Let's check it out. Post the adjusting entry to the unearned revenue and service revenue T accounts. Make sure to include the beginning balance and additional unearned revenue in the unearned revenue account. So it's basically putting this in. So we had a beginning balance of 25, and they want us to label it. That's the unadjusted balance, okay? And then we had 8,600 in cash collected for future services. That's what I called advances on revenue, okay? And then you had 7,300 in, well, I guess they don't want it all the way up there. Put it right here. 7,300 earned from advanced collections, and then you have an ending balance of 3,800. Ending balance. Okay. Now, I don't know if they want me to put this 50 in here. Right? That's the unadjusted. And then we have another 7,300 earned from advanced collections, so 57,300. Oh. What did I leave out?
Did you leave out balance?
You need to mark what the bottom service revenue box is.
Oh, I didn't put the balance in there. You're right. Okay. There you go. Good eyes. I was missing the label on it. Right here. Balance. Right? So you can see it's basically this here. And, right, if we had posted this transaction, you see the one I'm circling with my mouse? If I had completely posted it, then I'd have another 7,300 over here, right? We kind of whipped through that and we didn't make that posting, but we'd have another 7,300, and the ending balance would have been the 57,300. Does that make sense? Okay. Makes sense.
Wait.
Yes.
I don't have like that same problem, and I just follow the steps, but I don't think it works.
You have different numbers.
Yeah.
Oh. Okay.
Did you already do it? 'Cause I'm doing this similar to, and it's different from that one, or one of them. Because it generates different numbers so that you don't just put the same answers after you run through it.
Yeah, you're gonna have different numbers every time you try it.
But if you just like, you added the beginning,
So in your sentence up here, let's see.
So it's unadjusted balance.
So to make it balanced, you need to add the
Give-
debit from the first one.
Well, let's do it. Give me your numbers. So in the first sentence, at the beginning of the year, Nifty advertising old customers how much?
2,400.
So yours would be 2,400 here. Okay. And how much was advanced?
The same, 8,600.
Okay, and what was the ending balance?
2,800.
2,800. Okay. So for you, just double check it.
You add those.
You should be booking 8,200.
And then you plug it in as unearned revenue and service revenue, right?
Right, so we started here. And you debit unearned revenue and you credit service revenue. And did you put a label on it? You put a label here?
Oh, maybe that's it.
Maybe you're missing your label. Or your label might not be correct. To record service revenue, that was collected in advance.
Okay.
Try that. Now, how much revenue did you have to start with? You see where my 50,000 is here?
Yeah, 15,000.
15. So for you, it would be 15,000 here. This is a duplicate, really, of what's happening over here, okay, in my Excel sheet. And then you would have 82 because, let me draw you an arrow here. This 82 is here, right? And this 82, if we can get to the end of it, is here. Remember what we did the other day, right? We do journal entries first, and then we post them to the accounts, okay? But with accounting, you're required to be able to think backwards and forward. So we had to back into the revenue amount, okay? So what would have happened is these entries would have been made, and then we would post them to the account. So this is the debit to unearned revenue, and this is the credit to service revenue.
So this
This
is
is checkout.
This is adjusting.
This is adjusting. It's actually adjusting the account called unearned revenue. Unearned revenue is what kind of account?
Liability.
It's a liability, and we can also call it a deferred revenue. So you're deferring the recognition of revenue. You're deferring the recognition of revenue until you've actually earned it. Okay. So that liability is a deferred revenue. There's 4 types of adjustments. There's accruals of revenue, accruals of expenses, adjustments to deferred revenue, and adjustments to deferred expenses. Can anyone tell me what a deferred expense might be? More like the prepaid stuff. So like if you
insurance
yeah.
and
Yeah.
stuff like that.
So a deferred expense sits there as an asset until you actually use it, then it turns into an expense. So you're deferring the recognition of the expense. Okay. What else do they want me to do in this problem? There's another requirement, okay. Record the adjusting entry assuming that Nifty records the cash receipt of unearned revenue by initially crediting a revenue account. Okay. Post the adjusting entry to the unearned revenue and service revenue T accounts. Make sure to include the beginning balance. Okay. So what they're telling me now is, let's come back over here. My original, right? Because I put your numbers into so instead of
doing it the alternate way, because this is just another way of representing what we want.
right. So what they're saying is instead of this happening here, they went directly to service revenue. So we're going to modify this. We'll say service revenue. So instead of this going into the liability account, right? You can take this out too. It went over here. 86. Mine was 86, right? Okay. right? So you had 86, right? They're on a cash basis. So this is what a cash basis company would do. They would record revenue when they receive cash. So it's not really tied to the earnings process. This is how your taxes are done a lot of times on the cash basis. So every time you receive money, you're recording revenue. So what they initially did was they booked 8,600 to cash when they got that 8,600, and then they recorded 8,600 in revenue. Okay. So what they want me to do now is they want to make an adjustment. Okay. And they need to adjust it so that we hit this ending balance. Okay. So think about that.
Can't we just do that?
They're going to be different though, right? Because we got to move some money out of revenue and put it into unearned revenue. We put too much into revenue, right? So we got to move the difference. What is the difference? $1,300, right? So you're gonna put an additional 1,300 here, and you're gonna take 1,300 out of service revenue. Okay? So that would be your adjusting entry. So instead of debiting it's almost the opposite, but not for the same amount. It's just an opposite dynamic, right? Because we need to get the unearned revenue account to 3,800. It's only at 2,500. So we got to bring it up by 1,300. Double check that. See if that makes sense to you mathematically, right? What they're telling me is, initially the company, when they got that advance, they called it revenue, even though they didn't earn it. So they put it all into revenue, right? Same cash collection. Okay. Now at the end of the accounting period, they're saying that we actually have 3,800 in unearned revenue. Nothing else had been put into unearned revenue because we booked it all to revenue. So we need to put back enough into unearned revenue to show the correct unearned revenue balance of 3,800. So if I did the math right, it's 1,300 that we have to move. And
So what do you debit?
we're going to debit, it's right here on the bottom. We're going to debit service revenue, and we're going to credit unearned revenue, and then to record additional unearned revenue. Okay? You see how I did that? You see how it's different? Right? They show you this second way because a lot of small companies keep their books on the cash basis. And a lot of times as accountants, we have to go in and adjust the books so they're on an accrual basis. Okay? Especially if they need to file financial statements with the bank or some entity that needs generally accepted accounting principle prepared financial statements. Okay? So this actually brings this is going to bring the unearned revenue back to the correct balance. Okay? It's just that it's being done differently. We still start with 2,500. That's the beginning, right? And we're still going to end with 3,800. That's the balance at the end. Service revenue, 50,000. Okay, that's the beginning. Then we had an additional 86 that went directly to service revenue, right? I don't like the labels they're giving me. Okay. But in the end, you're going to take 1,300 out of there. I don't like the options of the labels they're giving me, but let's put this 3,800 in there. This would be your ending balance. Okay. And then you would have that 1,300 here. I'm just posting this entry right here, this second one. See, that's the 1,300. So let's see what we can call it.
Don't we have
Addition.
to debit something on the other side?
Yeah, here's the debit. See the credit and the debit? It's just a matter of taking this transaction down here in gray and sticking it into the T account, which we already did here, right? Now, your service revenue needs to go down by 1,300, and your unearned revenue is going to go up by 1,300. So this balance should end up being the same as what we had previously, 57,300. Okay? So this should end up being 57,300. It's just that we got to label it, right? What are we going to label it? We'll call this additional unearned revenue, and this one cash collected for future services. We might not get it right with the label. Oh, we got it. Okay.
What is the 86?
86. Okay, so first way, right?
Where did you get the 86 from again?
The 86 is right here in the sentence. See?
After.
Yeah. So this was the first way we did it. We did it purely on the accrual basis. And then the second way we did it, right, it's going to be different right here. This is what's going to make everything different. I put it in orange, right? The first way we did it, we properly recorded it as unearned revenue when we received the cash. The second way we did it, we called it revenue. See? Right here in bold. Right? We called it revenue when it really wasn't revenue because we didn't provide $8,600 worth of services. Okay? Technically, we only provided $1,300 worth of services. Okay? So you can see the difference between doing it on the accrual basis and then doing it on the cash basis and making a back end. We're actually making a back end entry to bring it back to the accrual basis. Okay? Had we not made this $1,300 entry, then our accounts would be sitting there on the cash basis. We would be showing all of that revenue, right? $58,600 of revenue. We would be showing all of this as revenue when 1,300 of it had not been earned yet. Okay, 1,300 of that total was not earned because the services weren't provided yet. Okay? Does that make sense? This one you're going to have to maybe do a couple times to really get a handle on it. But I would suggest kind of reading the book too on this one, because it's all dealing with this thing about getting cash before you provide the work. Okay, and how do you handle that, right? So if you're going to a small company that doesn't have an accountant in the house, right, they'll probably do it the second way. They'll probably book the full 8,600 as revenue. Okay, and then at year end, when you come in and you're the accountant, you're going to need to adjust these books so they're prepared on an accrual basis. You're going to have to fish that out and find out, okay, how much of this money that they collected have they not earned yet? Okay, and how much of that did they stick into revenue? We got to move that out. That's what we're doing with the 1,300. We're moving it out of revenue and reflecting it as a liability. We're actually showing it properly as a liability. They still owe 1,300 in services. Okay. What is this thing asking me on the bottom? Compare the ending balances of the T accounts under both approaches. Are they the same? Well, you can just scroll and eyeball it. 38, 57.3, 38, 57.3. Oh, they want you to restate it. Right. The ending balances in the unearned revenue account and the service revenue account are the same, regardless of which of the two approaches is used. And I'd like to add a little note to that. Regardless of which of the two approaches are used, assuming that when you get to this cash basis method, somebody is savvy enough to make this adjustment that I have in gray here, right? If you don't have someone with the accounting background, they might just let it go, and the company ends up doing what? Reporting more revenue than it actually has. That's an overstatement of revenue. Okay. You could get in trouble for that. Remember Enron and Tyco? The 2000. You don't remember 2000 when the tech bubble collapsed? Where were you in 2000? Oh, I'm sorry. Okay. Let me